The business, I would say, what has really changed is the mix has shifted, right? You've seen a more of a mix shift towards services side. And I think that's one of the reasons why you're seeing the multiple kind of completely grow. The question that always comes with investors is that, hey, what about valuation? The stock is expensive. And, the interesting thing is here we are sitting close to $470. And the valuation argument has always been the pushback for the last $300 in the stock. In other words, the valuation has always been a big bear pushback. But at the end of the day, as the business evolves, and even if some of the arguments I heard is like, the revenue levels are still flat versus a few years ago, the bottom line is the mix has shifted. You're seeing more services in that same revenue and the earnings mix relative to what it was in the past.
I've trimmed it a couple of times this year, and that certainly is an incrimination to me. But on the other hand, even after trimming it, it's still a 5.5% position in my portfolio, which is very large for anyone who's running a diversified portfolio. And even so, that's underweight to the market, okay? At the market, it's about 6.5%. So what I'm really trying to get at with this is that, Apple is the market right now. It is, in my opinion. And you have to decide, is this market and thus Apple trading on fundamentals, or is it trading on a sugar high of fiscal and monetary stimulus? Now, I'm not going to shoot Apple in the head because I own 5.5% in my portfolios. Why would I do that? But I do have to acknowledge that underneath this are some artificial supports to this market that leave me, to use your words, a little less enthusiastic than the rest.
I think there's a lot of fundamental tailwinds behind the move that we witnessed since August of 2018 for Apple. I do think when you look at Apple and you give consideration to if you hold it in a portfolio, whether you're getting out or not, you just can't get out of the stock. Listen, I'll tell you, if the next $50 for Apple, Scott, it's probably down. But I'm not getting out of the stock. It's 7% right now, and it's waiting of the S&P 500. So you and I had a conversation in August of 2018 when Apple exceeded $1 trillion, first U.S. company to do it. And at that time, I said the ceiling will become the floor. And that's exactly what has happened for Apple. It has happened for Amazon. It has happened for Microsoft. I think in the coming months, we're going to be talking about Amazon and Microsoft eclipsing $2 trillion. So I'm not afraid of that number. Saudi Aramco in December of this previous year exceeded $2 trillion. There's fundamental validity why Apple is priced where it is currently, and there's fundamentals behind it. And be ready for a pullback. A pullback will happen in this stock. In August of 2018, when it exceeded $1 trillion, the next move was down 35%. But thereafter was right back up 200%. So I think you have to expect that. You stay with it, and given the significant weight in the S&P, you can't get out of the name.
We don't own it because the actual operating earnings growth over the past 4 years or so hasn't really been that impressive. It's only been in about the 5% range. What's driven the overall earnings growth has been the tax cuts and buybacks. Also, a lot of the revenue growth has been driven by pricing increases, not by unit sales increases. So that's what's held us back up until now. And then what holds us back at this point is in fact that great quarter that they just had. And what I think is probably the case is that a lot of revenues were paid forward into this quarter as people started working from home and kids started needing to go to school at home. And I think that there was a huge acceleration of iPad sales and laptop sales and all sorts of device sales that were accelerated into a short time period, which could leave a hole in the future. So I think Joe's right that the next move very well could be down. I hear Steve on the big 5G phone sales. I'm not as enthusiastic on that as he is. So we haven't held it. We're not buying it now, but I want to make one other point here. You do not have to have held Apple to have done very well and generated great returns. It's one stock in a portfolio. It's up about 60% year to date. There are other companies that are up 60% year to date too.
I think it's great. It's been surprising because when you sort of look at it, I think for a number of companies, especially tech companies and sort of Apple, they've done great. But there's a whole part of the market that just isn't participating. I mean, I could tell you like a week ago, 2 weeks ago, we invested in a company, Diamond Offshore, where think of this, they've got $450 million of bank debt that's secured. They've got $450 million of cash. And we ended up buying the bank debt at 65 cents on the dollar. So, and the company makes about 150 million of EBITDA. They'll make 100 next year. It's what you talk about. You've got the haves and the have-nots. If you're the haves, life is great. If you're the have-nots, in a zero-rate environment, we're able to make all these investments. So it just doesn't make sense, but that's sort of where we're living.